Jai Hind, friends. Nobody taught us this stuff. Not school, not our parents. And here is the thing that one gap in your knowledge, it's costing you money right now, today. So, in the next 10 minutes, we are going to fix that. I'm going to walk you through the financial terms that actually matter, and more importantly, what they mean for your wallet. Here is the deal. Most people think personal finance is complicated, and it seems that way because it's full of terms that sound like they were designed in a boardroom to keep regular people out. But once you crack the code on the vocabulary, everything clicks. We are going to cover the 10 terms that show up everywhere in your financial life, from your bank account to your investments to your credit card bill. I am not going to waste your time with textbook definitions. I am going to tell you what each one means and why it actually matters to you. Let's start with the most basic one, income. Income is simply money coming in. But here is what school never told you. There are two types. Active income is money you earn by trading your time, your salary, your hourly wage. You stop working, the money stops coming. Passive income. Passive income is money that comes in whether you are working or not. Rent from a property, dividends from stocks, a course you built once that keeps selling. The reason this distinction matters because building passive income is literally how people reach financial freedom. You can't work your way to wealthy. You run out of hours. But passive income has no ceiling. Now this one is big one. Robert Kiyosaki built an entire best-selling book around this idea. And he is right. If you only remember two words from this video, make it these. An asset is anything that puts money in your pocket. A rental property, stocks, a business. A liability is anything that takes money out of your pocket. A car loan, credit card debt, a mortgage. Yes, even your house is technically a liability if it's costing you money every month. Rich people collect assets. They let assets pay for their liabilities. That's it. That's the whole game. So if assets are what you own, liabilities are what you owe. Net worth is the difference. Simple formula. Net worth is assets minus liabilities. If you save 50,000 in savings and investments, but 30,000 in student loan and car debt. Your net worth is 20,000. That's your real financial picture, not your salary, not your job title. Net worth is your scoreboard. Here is why this matters. Your goal isn't to earn more, it's to grow your net worth. You can make 200,000 a year and have negative net worth, and someone making 50,000 a year can be quietly building real wealth. The number on your paycheck is not the point. And this leads us directly into cash flow. Cash flow is simply how much money comes in versus how much goes out every month. Positive cash flow, you are keeping more than you spend. Wealth is being built. Negative cash flow, you are spending more than you make. Debt is growing. Here is the brutal truth. You can earn a lot of money and still have terrible cash flow. Ever heard the saying living paycheck to paycheck on a six-figure salary? That's a cash flow problem. Managing your cash flow is one of the most powerful financial habits you can build. Okay, now we get to the two forces that will either work for you or against you your entire life. Pay close attention here. Albert Einstein allegedly called compound interest the eighth wonder of the world. Whether he said it or not, it's true. Compound interest means you earn interest on your interest. Let me make that concrete. If you invest 5,000 at a 7% annual return. After 1 year, you have 5,350. But next year, you earn 7% on 5,350, not just the original 5,000. The longer this runs, the more insane it gets. That same 5,000 left alone for 30 years, it becomes over 38,000 without adding a single extra penny. This is why starting early beats starting big. Time is the real asset here. But compound interest has an enemy, and that enemy is inflation. Inflation is the rate at which prices rise over time. If inflation is 3% per year, that means 100 today only buys 97 worth of stuff next year, and the year after, a little less again. Why does this matter? Because if your money is just sitting in a savings account earning 1% interest and inflation is at 3%, you are actually getting poorer every year. Your money exists, but it's by less and less. This is exactly why investing matters. You are not trying to get rich. You are trying to beat inflation. I know the word budget makes people cringe. It sounds restrictive, but here is a reframe that might help. A budget isn't about saying no to things you love. It's about telling your money where to go before it decides on its own. The most popular budget framework is 50-30-20. 50% of your income goes to needs, rent, food, utilities. 30% goes to wants, dining out, subscriptions, hobbies. 20% goes to savings and debt repayment. You don't have to use this exact split, but having any plan is infinitely better than no plan. Untracked money disappears every single time. Speaking of savings, let's talk about the financial airbag every person needs. The emergency fund. An emergency fund is 3 to 6 months of your living expenses saved in cash in a separate account that you don't touch unless something actually goes wrong. Job loss, medical bill, car breaks down. Without one, any surprise expense goes on a credit card, which becomes debt, which starts accruing interest, which spirals. With one, you handle it, you recover, and your financial plan stays on track. It's not exciting, but it's the single most stabilizing thing you can do for your finances. Your credit score is a number, usually between 300 to 850. That tells lenders how trustworthy you are with borrowed money. The higher the better. Why should you care? Because your credit score affects the interest rate on your mortgage. Whether you get approved for an apartment, sometimes even job applications. The three biggest things that affect your score: paying bills on time, keeping your credit card balance low, and not opening too many new accounts at once. That's 80% of the game right there. Okay, last term, and it's really three in one. A stock is a small ownership stake in a company. When that company does well, the value of your stake goes up. When it doesn't, it can go down. Higher risk, higher potential reward. A bond is more like a loan you give to a company or government. They pay you back with interest. Lower risk, lower return. Bonds are the boring but reliable options. And then there are index funds, the one most beginners should probably start with. An index fund is a basket of stocks like the 500 biggest companies in the US, all in one investment. You are not betting on one company. You are betting on the whole economy. Historically, the S&P 500 index has returned about 7 to 10% per year over the long periods. That's why it's the starting point most financial advisors recommend for beginners. You don't need a finance degree. You just need to understand what you own and why. Before I wrap this up, if you are finding this useful, hit subscribe. Now let's bring this all together. So let's do a quick recap. 10 terms that are going to change how you see money. Income, active versus passive, assets versus liabilities, collect assets, manage liabilities, net worth, your real financial scoreboard, cash flow, what's coming in versus going out, compound interest, time makes money grow exponentially, inflation, your silent enemy if you are not investing, budget, telling your money where to go, emergency fund, your financial airbag, credit score, your financial reputation, stocks, bonds, index funds. How money grows beyond savings. Here's the thing, you don't need to master all of this overnight, but every single one of these terms is going to show up in your life. And now you are ready for it. Drop a comment. Which of these terms did you wish you had learned earlier? I read every single one. See you in the next one.